Yesterday, you all had an interesting session with Yogesh where he covered about the basics of the financial world. He spoke about the different asset classes and how you can invest and trade, even on the demo accounts. He showed you all multiple trading strategies. So, yes, today's session will not focus on trading, we'll focus more on investing. But like Yogesh discussed with you all yesterday, he also shared multiple trading ideas and how you can trade on your demo account. So we have in fact even mailed the demo accounts to everyone, and you all can start practicing on the demo accounts, get a feel and get an idea of how the trading platform works, and just enjoy the session and just go with the flow. So today's session, we are going to shift and divert from trading, and we're going to focus on investments. So we are going to see how we can grow our wealth and how we can preserve our wealth further. So without much ado, let's quickly begin. So I would be sharing some of the golden rules of wealth creation and preservations that will actually help you, throughout your financial journey. Now, before we get started, I have one question, and if we make this interactive, it's going to be good for you as well as for us. The learning will be much more, and that's our primary focus to create as much financial awareness as possible. Now, right. So when we say that we need to invest, we need to, grow our wealth. Why do we need to invest? That's the basis and the core, question that you all need to be aware of. That why is it that we all need to invest? Why is it that we need to grow our wealth? Okay, someone's asked that will we get this presentation? Yes, absolutely. The presentation will, and the entire webinar eventually will get uploaded on our website, on our YouTube channel. So it would be available over there. So don't worry about that. So I just asked the question as to why do we need to invest? Come on, guys, let's make this nice and interactive. Anybody, any reason why do we need to invest? Okay, to be someone saying to be financially free and supplement our income from various sources. Very good. To someone saying to we need to invest to chill in the future. Great, that's amazing. That is another rule of our investments. That's how it will help us. But here I'm looking at the core reason as to why it is necessary to save and why is it necessary to invest. The reason why it is necessary to invest is to fight inflation. If you don't, then the purchasing power of your money will start reducing. So here you can see basically in the year January 1926, if you had $100, if something costed $100, that same thing as of 2020 will cost you $1,500. So you see your buying power went down drastically. In the meantime, if the same money, that same $100, if you would have invested in the US stocks, that would have grown to a massive $45,000 at the end of 2020. So not only if you invested in the US stocks, not only would have it surpassed your inflation needs, but obviously, like others said, we need to invest to chill in future, to be financially free, and all your other goals would have also been met. So yes, that would have been the use of saving and of investments. But the key purpose of investing, maybe not in the stock markets or even in your bonds or in your savings account, the idea is that you need to fight inflation. So we need to save and we need to invest. Now, what we would be covering today are the golden rules of investment that will help you achieve this financial independence. So, like you can see on the slide, there are different golden rules, and we'll tackle each one at a time. The first one being we need to start now. Now, let's understand why do we need to start now. So there is something, if you would ask me, If there was an eighth wonder in the world, I would have said it would have been compound interest. Now, the power of compounding is massive and huge, and that is what basically helps your wealth grow. And that is why it's very important and very necessary that you start as early as possible. Now, to understand the magic of compounding and how it works, there is a question that I would like to ask you, and I have asked this question at multiple podiums, and everywhere I have asked this question, it has always, raised an eyebrow and created that awareness that, oh my God, this is the power of compounding. In fact, this very question was asked to me by my dad when I was very young, and that's how I got into investing and in the world of finance. So here's how it works. Basically, it's like a 31-day deal, wherein on day one, you have to pay 50 fils. On day two, you have to pay 1 dirham. Then it doubles to 2 dirhams. Then it doubles to 4 dirhams. Then it doubles to 8 dirhams. And so on and so forth. So that's how it works. It's just a deal for 31 days. This is what you need to do in 30 for 31 days. And in return, I would be willing to pay you an amount that you can say, come on, use your chat boxes and write in the amount that you would want me to pay you in return for this deal. So all you have to do is pay 50 fils on day one, 1 dirham on day two dirhams on day four, and so on and so forth. Every day the money will double, and you just need to do it for a span of 31 days. I'm waiting. So you need like $10,000 in return, or you need sorry, I'm speaking in dollars. Okay, let's stick to dirhams. Maybe you need 10,000 dirhams. You need 50,000 dirhams. What is the amount that you need? Okay, so Vida has said she needs, wow, she needs 200,000. That's quite a big amount. Amazing. Wow, someone has said he needs a 1 million AD. Ashok has said he needs 1 million AD. Great. There's someone who's already given me a correct answer. I'll take that person's name towards the end. But for now, let's just do the math, and there's someone else who said they want just 50,000 AD, and he and she would be happy. So nice. Let's do the math and let's understand how does this work. So basically, we start with 50 fils on day one, then it's 1 dirham, 2 dirhams, 4 dirhams, 8 dirhams, 16, 32, 64, 128, 256 dirhams on day 10. Okay, I'm rounding it off for convenience to 250. Then it goes to 500, 1000, 2000, 4000, 8000, 16,000, 32,000, 64,000, 128,000, and 256,000 on day 20. So someone asked for 200,000, so he or she is already making a loss right now. Then we move on to 500,000, 1 million, 2 million, 4 million, 8 million, 16 million, 32 million, 64 million, 128 million, 256 million, and 500 million on day 31. So, okay, firstly, nowhere on earth you get these kind of returns, or if anybody's promising you any kind of returns like this, even on an annual basis, it doesn't happen. This was just an example for your understanding about how compounding works. Like, what's the none of us could even imagine that we just started with 50 fills, and if it keeps doubling, it goes up to 500 million on day 31. So that's the math, and that's the power of compounding, and that is what I was talking about. Now, if you can see to this slide over here, what we've shown is that if you're investing $10,000, and if it grows annually at the rate of 10% over the years, in the next 25 years, you would have accrued $108,000. So what it means is that your investment is only $10,000. The remaining 98,000 is the extra money that you've earned, and that's just because of the compounding effect. So that's how the benefit and the power of investments are. Here's another example. So we have two friends who've started investing. Now Ria has started investing, say, at the age of 25, and Shreya, on the other hand, has started investing at the age of 35. Both of them are investing just $5,000 per year. So, and they're going to invest for a period of 40 years in case of Ria, who's planning to retire at 65. And in case of Shreya, she's going to also retire at 65, so she'll invest only for 30 years. Now, Ria over here is investing for 40 years, $5,000 per year, which is 200,000. And on the other hand, Shreya is investing 150,000 because she's investing only for 30 years. Now, I'll quickly start a poll wherein you need to tell me, what do you think would be the difference in the wealth accumulated by Ria and by Shreya? Can you guys see the poll? So what is the difference in the wealth accumulated by Ria and Shreya? All right, we're getting responses. All right, so we have most people who've said that the difference would be, I'm glad that many of them are getting it correct. They have said, we have 20% who've said that the difference would be $450,000. We have 10% who've said that the difference would be $200,000. We have 40% who said that the difference would be $1 million. And we have 30% who said that the difference would be $1.4 million. So the 30% can give a tap to themselves. They've got it right. The difference would be $1.4 million. So you see the difference in the wealth that was Ria invested 200,000, whereas Shreya invested 150,000. So difference was just $50,000. But that $50,000, the magnitude was so huge that it's created a wealth difference of 1.4 million between the two of them. So which is why I said it's really key and really important to start as soon as possible. Now, here's another example. We have three individuals who are investing $1,000 per month, again until the age of 65, and we'll continue with the 10% annual growth rate. We have Rian, who's starting at the age of 25. We have Karthik, who's starting at the age of 35, and we have Akshay, who's starting at the age of 45. Now, if I would show you the differences in the wealth accumulated between the three of them, the amount would be, the difference is crazy. So the earlier you start, the better it is. For Rian, he would have accumulated a massive $6.3 million at the age of 65. On the other hand, Karthik would have accumulated only $2.2 million. So you see, just a difference of 10 years, your accumulation drops by $4 million. And when it comes to Akshay, he would have accumulated only 758,000 in the next 20 years. So if you look at the difference in the amount invested, it is just the difference in the amount invested between Akshay and Rian is just $240,000. But the difference in the wealth accumulated is almost $5.5 million. So Again, I'm just stressing the importance of the earlier you start, the better it is. In the financial world, there is a saying that when is the best time to invest? The answer is not today. It was actually yesterday. Yesterday was the best time that you should have started investing. Basically, what it means is that if you are not already investing, you're already late. So, I think we've cleared this point massively about the importance and the benefit of starting as soon as possible. Moving on to our next, in fact, I had a question on this as well. I hope you guys can see. The next one was to, to not to try and time the markets, and we have to continue with a regular standard investment on a regular basis. It's something called as an SIP, wherein you would be investing, say, whatever be your capacity. You want to invest $100 every month, you want to invest $500 every month, or you want to invest $1,000 every month. Whatever your capacity is, you just invest that regularly in the markets. I believe Yogesh must have covered yesterday what are different indices, what are the different asset classes. There is a standard index in the US, which is the S&P 500. This is the index which is tracking the largest 500 companies in the United States. So instead of investing in each particular stock, if you're directly investing in the S&P 500, you're basically getting an exposure more or less to the largest companies in the United States. And it is a pretty diversified exposure because we have exposure to more than 500 stocks. Now, coming to this question, wherein if you would have invested, say, $1,000 every year, or if say our parents would have invested for us, starting from the year 1990, maybe, if someone would have invested for you $1,000 every month regularly in the SPX 500, how much would have the wealth been as of today's date? Let's try and see what do you get. I've started poll, waiting for your answers. I believe many of you already saw it on the first page when I did share the screen, but still, many of you are getting it right though. Is it 12 million? Is it 5 million 80? Is it 2 million 80? Or is it 1 million 80? Okay, I can see it's getting a tie between two answers. All right, so there's a lot of vote coming in for 5 million 80. We have some people also voting for the 2 million 80. And the maximum votes are for 12 million 80. So I feel now all of you have already started thinking very big. The numbers all look very big. So again, and if you did get this right, we would have 12 million 80 in our account if we would have almost 12 million 80 if we would have started investing in the year 1990. So now, UAE came into effect in the year 1971. So, if someone was in UAE and started since the year UAE was born, so our total investment in dollar terms would have been $639,000, which would have accumulated to a massive $32 million. And in dirhams, it would have been 120 million dirhams. Same ways, if you would have started in the year 1980, it would have grown up to 44 million dirhams. If we would have started in the year 1990, I believe many of us were born in or around between 1980 or 1990, or maybe 2000s also, I don't know. But if we are born anywhere there, and if our parents would have invested this for us, now most of us would have had now 12 million dirhams sitting in our bank account. So it would have been lovely. And even if our parents have not done it for us, we can start doing it for our kids or for our future as well. Just have a better, healthier future, wherein at least one area wherein you're not stressed about would be your financials. So the benefit about and okay, before I move on to the benefit, just look at the recent investments. Like for example, 2008 was relatively, like most of us even saw the crash that happened in 2008. It's just a span of 15 years. And if we would have done this investment regularly for a period of 15 years, we would have had 2.4 million dirhams in our account. So that is what we would have had sitting in our account. Now, moving forward, let's understand what are the benefits and what are the advantages of the SIP method that we just spoke about. Firstly, first and foremost, and the key benefit over here is that it brings about a great amount of financial discipline, right? And like whatsoever, you don't have to worry if the markets are at high, if they're at a low. You don't have to bother about timing the market perfectly. All you need to be concerned about is, just regularly investing that particular amount. Secondly, obviously, it is pocket friendly because you don't have to put in a big chunk of money, at any given point in time. It's just $1,000 or whatever be your amount, $500, whatever is easy for you. You start with that, and we've already seen the compounding effect and the benefits that it does have. And most importantly, it also leads to dollar cost averaging, which is wherein it reduces the risk of lump sum investing. Say if I invest every all that I have right now, and if markets crash, so then I'm facing a major loss. But if we invest regularly, you don't have the chance of hitting a major loss. And obviously, if stock prices do fall, you get to average at better prices. Now, that would, I think, bring us to the next question. So, what do you think about the markets? Is the worst over, or are we going to see any kind of further sell-off, or will have the markets peaked already? Will they continue to rally? What it is that we are expecting? I think the biggest fear that right now everybody has is that maybe markets have rallied significantly, and we may expect some correction from here. Everybody was expecting that last year as well. But we did see markets fall to some extent, but the kind of crash that all of us were expecting didn't really happen, and markets continued to rally. And that is where, and that is how it is important to not try and time the market, and rather keep investing regularly, because that's how you get to, capture the maximum benefits that you can from the market. Because the problem about markets is that it's very difficult to time the markets. Okay, so before I get on to that particular aspect as to why it is difficult to time the markets, just let me, just throw some light on the numbers over here. So, a typical bear market, over the past 80 years has seen equities decline by an average of 35% from their peak. Okay, so from the high point to the low point, the maximum on an average that we've seen, the fall has been 35%. Even during 2020, when market crashed, it would be surprising for most of you all. But if you, the correction that lasted, the recession that lasted for a period of only 2 months, saw markets losing only 1%. Well, the drop was significant. It did drop by almost 30% at one point in time. But then at the end of it, at the end of 2 months, the loss was just 1%. So, what I'm trying to say over here is that we can see a lot of volatility going forward as well. But when markets do fall, also, it can be viewed as a buying opportunity from a long term perspective, because all we need to do is we need to regularly invest in the markets. Now, why do we need to do that? And why do we not need to time the market is mainly because of this. Like if you see in the past, we've seen in the last starting from 2000, we've seen three recessions. Now when we've seen three recessions, despite that, This data is only till the year 2020. So despite that, the S&P has gained 300%. This does not even include your dividends that are reinvested every single time. So the point that is being tried to convey over here, that in the last 20 odd years, there has been three major recessions, and despite that, the returns that have been delivered by the markets, it has been significant. So coming to my point, what I was trying to say earlier, that trying to time the market and trying to time when the bottom is, and only then I want to invest. That doesn't really make a good sense, and that is something that is very difficult to do. From a trading perspective, one can do that. You try and look for your bottoms. You try and look for your support levels. You try and look for a resistance level. Yes, from a trading perspective, that is something that one should be doing. But from when it comes to markets and when it comes to investments, and that's when you're trying to time your investments, that I want to buy exactly at the bottom and I want to sell exactly at the top. That is something that is very difficult to do. I don't even think Warren Buffett has got this right in the past ever. It's If you end up being right on one or two occasions, then that's probably good luck. But trying to exactly predict as to when the market will fall and when it will rise is something I don't think any of the geniuses in this world can also exactly tell you. So what now? Coming to so how do we invest in the markets? And well, it's not the timing. It is the amount of time you spend in the markets that help you, grow your wealth and preserve your wealth further. So, what it has been observed in the past is that markets tend to make their biggest jumps precisely when the volatility or when the chaos in the market is at the highest. Now, why is this question? Why is this particular point important? Well, this is important because it is very important that you stay invested in the markets and do not miss out on the best days of your invest of the markets. So what happens is that, look at this chart and try and just make some sense out of it. Like if you had $10,000 invested in the S&P 500 starting from the year 1980 till the year 2021, and if you stayed invested on all the days, you would have made $1 million, right? But just if you missed out on the best 5 trading days, just the best 5 days, okay, the wealth would have directly dropped to almost zero point 0.7 million. That is like a 40% drop in the wealth accumulated. And if you missed out just the best 10 days, the loss would have been, you know, massive. It would have been like a 55% loss in your portfolio. You would have had only zero point 0.5 million. So if you miss out on the best days of the market, that can be really, really costly. Now, what does this really signify and what does this mean? It means that staying invested in the markets, especially when on the best days, is very, very, very significant. And guess what? When have these best days come in the past? If you look at the data, the 10 best days in the markets from the year 2002 to 2022, the 10 best days, most of them came during the financial crisis of 2008 or 2009 and during the COVID pandemic of 2020. So in 2008, we had 11.6%, October 13 saw 11.6%, a single day return. October 28, 2008 saw 10.8%. You had March 24, 2020, when the SPX rallied by 9.4%. Then again, you had March 13, wherein SPX rallied by 9.3%. So, these best days came at a time when the market chaos was at the peak. And that is the time when all of us think that no, we don't want to invest in the markets. We are all panicking and we want to sell. And those are the days where you actually end up having the best days of the market. And if you miss out the best days of the market, I just showed you previously, the loss can be significant. This is another stat from Bank of America, which says that looking back at the data from 1930, if the investor missed 10 best days each decade in the S&P 500, the return would be merely 30%. Okay. Whereas if you invested throughout steady up and down, you would have had a return of 17,700%. So it's like every decade you're just missing out 10 best days, and what you're losing out is significant, which is why it is very, very essential to stay invested in the market. And one way that we can do this is through regular investments, be it an SIP, or you can use a ladder approach or a dollar cost averaging approach, whatever you're comfortable with. But regular investments in the markets and not trying to time the markets is very significant and very important. So this chart basically suggests how an investor generally ends up trying to time the market and what exactly happens. If any of you all are investing in the markets, I'm sure you would have been favorable. You would have been aware about these patterns. So okay, someone's asked a question over here that how do you know you are in the best days? Um, if it is pertaining to what I just shared previously, so this is the data that we were given in the the data that we've pulled out, and it shows that the S&P 500 has rallied by 9%. And when I say the best days, it means the maximum return. On an average, an index in a day would move by 1% or less than that. So when an index is moving to by an amount of 9% on a given day, then it's obviously considered to be some of the best days of the markets. So it's just something that we've pulled out. We've just looked at what are the worst days wherein an index is losing massively on a particular day, or when it is gaining massively on a particular day. And I hope I've answered your question, because yeah, someone's Tasneem saying amazing observation. Well, thanks, Tasneem. Okay, so quickly moving forward. So what happens is that this is how it works. When market starts falling, and if you say you've heavily invested in the market at a particular time, then we generally feel, no, maybe this is just a temporary pullback, and you're in denial. And when it drops further, we are like, oh, maybe it's too late to sell now. Let's write it out. And it drops further, and then over here we start panicking, like, no, 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 it's going to crash miserably. Let's start selling. And when markets fall further, then we feel that, well, it was a good decision to sell. And then when markets start going up again, so it's like you start telling yourself that no, no, it's just a temporary phase. Markets will come back again. They probably drop little, and then you're like, see, I told you, they're not going to rally further. And then markets start going up, and you're like, you know what? I'm not entering again after all what happened. I don't trust these markets. Then it rallies further, and you're like, oh, I should have bought earlier, and I'll wait and I'll enter at the next dip. But markets don't give a dip; they rally further, and you're like, okay, forget it. I'm not waiting anymore. Let's buy all in, and you go all in. And then markets rally further, and you're like, wow, it was a good decision. I'm glad I did not wait any longer. And then prices again start taking a breather, and then if they start falling, you're again in denial, and it's that same phase. So we need to break this trend. You rather need to, stop panicking when everybody's panicking. That is the time when you need to buy. And when everybody is in greed, that is the time you need to start selling. So, Warren Buffett used to say this, that when there's fear, that's when you need to buy, and when there's greed, that's when you need to sell. So that's exactly what needs to be done. Or an easiest hassle-free approach is to just stay invested in the markets, continue with your regular SIPs. Now, the key to breaking this, like I said, there is an amazing observation that has been seen since the year 1931, again, the start of the S&P. There has been no 14-year period wherein the index has lost money. So consider any 14-year period, say like from 1940 to 1954, 1945 to 1960, or from 2000 to 2014, any 14-year period, and the index has always given positive returns, right? So what this means is that the longer you stay invested, the chances of you ending up being profitable are much higher. So the probability, if you invest only for 1 year in the S&P 500, the probability that you can lose money is 24%, and the probability that you can gain is 76%. Now, change this to 5 years. If you're invested for a period of 5 years, the probability that you lose out on any money is just 12%, and the probability that you'll gain is 88%. Extend this further to 10 years, and your loss chance, the probability of a loss reduces to 5%. So that's how it is. The longer you are invested, the better it is. So this chart is exactly explaining the same. If you invest for a 14-year period, your losses are close to zero. Even if you invest for a 13-year period, the probability of a loss is just 1%. So that's the benefit of staying invested longer, and more so if you're regularly doing your investments on an SIP basis, then the chances of losses are even lower. Now, now, this is something. Moving on to our next topic, which says that right, we need to do SIPs, we need to invest regularly. Fine, we need to start as early as possible. I get that, but where do I need to invest? How do I need to invest? So those are questions that need to be tackled. So coming to our third important parameter, which speaks about diversification. Now, diversification is really important. It just helps you ride through the different market phases. For example, if you have all your wealth in equity, and tomorrow, if equity markets crash miserably, and someone needs those funds, say maybe someone was investing for education purposes for their kids' education, and next year you need those funds, and equity markets have crashed miserably, then what do you do in that kind of a scenario? You cannot sell everything at the cheap prices because equity prices have fallen. So in that case, you would be, in a dilemma. Now, to manage that, it's always important that your portfolio is well diversified and balanced across different asset classes. More so, it needs to be majorly the two major asset classes that have been spoken about relate to fixed income and equities. I believe Yogesh has covered each of these in yesterday's session, so I'm not going to talk about them in detail, but you can consider it, as the way I've shown it, it's like a wardrobe for maybe a female's wardrobe, wherein you have one section for every particular, item. So likewise, your financial wardrobe should also look like that, wherein you have some investments in your bonds, some investment in equities, maybe some real estate, and so on and so forth. So you can decide for yourself maybe some amount of gold as investment. So you can decide what and how you need to diversify your portfolio. So coming to that particular question, that how do you diversify and how do you decide how the portfolio needs to look like? Well, in that case, two particular, again, this was also something that was covered by Yogesh, but primarily the factors that need to be taken into consideration are your time horizon and your risk appetite. The longer the time you have for investments, the more you need to be invested towards risky assets like equities. And the more your risk appetite, the more you focus on the equity market. The less your risk appetite, the more you focus on the bond markets or in fixed income equities. So there is a traditional rule that has been followed as to how much do you need to allocate. For convenience, we just stick to bonds and stocks over here. It's basically how much needs to be in risky assets and how much needs to be in conservative assets. So the standard rule, that is the classic recommendation in the financial world, is that you just need to do 100 minus your age, and how much needs to go in stocks and how much needs to go in bonds. So say if you're 30 years, 100 minus 30 would be 70. 70% should be invested in equities and 30% should be invested in bonds. The reason why we need to invest 70% in equities is because equities are considered relatively riskier, right? But they also are considered as an asset class which provides you more returns compared to the bond or the fixed income markets. So they are something that will help you, fight the inflation like we saw, and which is why a higher proportion needs to be invested. The younger you are, the more risk you can take, and hence the allocation needs to be higher towards riskier assets. In fact, given the fact that the age threshold has gone up, medical advances have been significant. So since the average age threshold has gone up, we have many portfolio managers or other funds which actually recommend doing 110 minus your age or 120 minus your age, which needs to be invested in the stock markets. So these are the different ways. Of course, this is just a parameter based on your age. You need to consider your financial goals. If you need the money, like I said, the next year itself, you cannot invest everything in the equity market because when you're investing in the equity market, we need to ensure that we have a sufficient time, at least 5 to 10 years before you can withdraw those funds. So that is something that needs to be kept in mind. You can always plan with your consultant or your finance manager as to how you need to invest and plan your investment. Now, another part of diversification would also involve us um, to diversify not only in a particular, like say in a particular stock such as U.S. markets or Indian markets, but it also needs to be diversified across different economies, across different globes. So it's not the diversification is not only between different asset classes such as bonds or equities, it's also between different economies. Now, I don't know if we have many expats over here who are investing in the Indian markets, who are already investing in Nifty, then we've had crazy returns. In the last couple of years, Nifty has rallied significantly. Well, that's amazing. But at the same time, we need to understand that the rupee has depreciated a lot in the last a couple of years, because of which you're losing out on your buying power. So again, just to understand, there's a small example over here that has been shown. So you started investing in the year 2008, and if you're investing in the year 2008, you've invested 10 lakh rupees, and we've invested that in Nifty, which has given amazing returns, 327% returns so far till 2024. So that 10 lakhs would have grown to 42 lakhs, which if I convert in dollar terms, as of the current rate, that would have been $51,000. Now, moving on, if the same amount, let's see what would have happened if you would have invested in the S&P 500. The S&P 500 has actually grown only by 272%. So it has underperformed the Nifty actually. Most of the underperformance has happened in the last year itself, where Nifty has rallied significantly. So this 10 lakh would have translated to $25,000 back then in 2008. So $25,000 invested in SPX 500 would have actually grown to $91,800. And if that is translated again into rupee terms as of today's date, that would have been 76 lakhs. So if you invested in Indian markets, that would have been 42 lakhs. But if you invested in the US markets, the same amount would have now been worth 76 lakhs. So it's almost, I mean, not double, but almost nearly double. So that's the benefit of investing in global markets, because you have invested in dollar-based assets. So dollar being the world's strongest currency, it allows you to gain the benefits and avoid the losses that you would have saved from a rupee depreciation. Also, the biggest benefit of investing in global markets, especially in something as strong as the US, is that it owns some of the largest companies. It has a market. It has the largest market capitalization. Compared to other equity markets in the world. So obviously, it makes sense to have some amount. I mean, be it an iPhone, be it Google, be it Microsoft. These are something that we use on a day-to-day basis, and these companies are all based out of United States. So investing in the U.S. stock markets really makes a lot of sense over here. Now, coming on to our fourth principle, which speaks about if you guys have any questions, you can keep asking. Okay, someone's saying, please share your PPT. Like I said, we will definitely. What are the charges for SIP in the American market? This is something that you can ask your RM. He or she will get in touch with you and explain you about how it has to be done. What are the charges? I am from the research team, so I won't be able to guide you on this. Does investing in passive index come under equities? Yes, it does. Passive index also does come under equities. Right. Yeah, keep pouring in your questions. Even if I'm not able to answer any of them, we can, in the webinar itself, because we have only another 15 minutes left. I'll definitely take up those questions. You can even reach out to your RM and we can have separate conversations, one-on-one conversations. We are here to help. So any questions, I, Yogesh, all of us are available for any help that is needed. So be rest assured, everything will be covered and will be looked into. Now, coming on to the fourth and the key principle is just to keep it simple. So, like I was saying, how can we keep it simple? Where do we invest? What do we do? In today's world, when there's so much information, then we have like cryptocurrencies, we have small stocks, and there are terms like FOMO, wherein you fear of missing out from the massive returns that we've seen in the small stocks, so those penny stocks. So there are Reddit investors. There's so much happening in the world, and then we just feel that no, we want to participate, and we also don't want to miss out on those returns. And then by the time we enter, probably markets have already started to correct, and then we just simply burn our time. Now, why does this happen? One, because we're getting into things that we don't understand. So it's very important that when you're investing, you should at least have some knowledge as to what you're investing. Or if you have no knowledge, then you invest it via a professional, via a financial consultant, or an advisor, or a portfolio manager who knows what he is doing. So it's very important that we invest in stocks or in ideas that we can relate to, that we understand, so that ways you'll also be able to track the performance. Otherwise, if you don't understand what's happening, if you don't know the management, or if you don't, understand the business of the company, then it would be very difficult for you to be personally involved with that particular investment. So there is something called as a circle of competence, wherein what they say is that you just stick to your core competence, just stick to what you understand, and in the previous slide I was speaking about diversification, but diversification is necessary to a certain extent. Over diversification is also not good. You need to have only those many baskets that you can manage. Multiple baskets is something which will eventually lead to could lead to losses, not necessary, but it becomes difficult to manage. So for example, when you say circle of competence, you invest in stocks that you understand. So what we can see over here, for example, you have a Starbucks. Everybody over here probably understands what a Starbucks does, or you have an Amazon, you have an Apple. For females, for example, if you don't if you don't understand all of this, something if you don't understand what an AMD does, or what an Nvidia does, if all of those are something that you don't understand in, but probably you know very well what an LVMH is about, or what a L'Oreal is about, or even for that matter, what Netflix or Amazon is all about. So invest in stocks that you can probably at least relate with, or you can understand And these are, big US names. It need not always be very complicated. Sometimes it's the simple things that help you make that kind of, wealth that is actually needed. So just focus on things that you understand, and even if you don't understand, make sure that you're investing via someone who has an idea or an awareness of those understandings. Okay, Jyotsna is saying needs someone to call, want to invest in indices. Right, Jyotsna, we'll definitely get in touch with you. The RM will make sure he or she gets in touch with you. What are the charges for an SIP in the American market? Yes, that would also basically the charges are very minimal as far as I'm concerned. But again, the RM would be the best person to help you answer that question again. Those are very the basic commissions that would be charged whenever you buy on any platform. So that would be bare minimum. Now, we were talking about the Peter Lynch method, wherein it says about just to keep it simple, where he focus on, you buy only what you understand, you always do your homework before you're investing, and you focus for the long run. You invest for the long run. So these are the key principles that we have already spoken about. Like I said, we need to start now. We need to ensure that we are not trying to time the markets. An SIP is something that can help us. We need to diversify, maybe across different asset classes or even across different economies. And then we need to keep it as simple as possible. Regarding the last point about we need to keep it as simple as possible, I would also be sharing a few ideas and tips as to how we can invest in the current market dynamics. So that will really hopefully help some of you over here. But it's very important that you understand that all what we've shared over here, none of them has to be taken as an investment advice. This is only as a financial, awareness that we are creating and conducting these webinars. The motive and the purpose is to create as much awareness as possible. If you need any kind of financial advice or so on, you can always get in touch with your RM. He will connect you with a consultant, and things can be taken forward from there. So quickly, and now since we've discussed everything, so the whole thing is okay. What do I need to do? How do we need to do? And how do we need to get started? So first and foremost, whenever you start investing in the markets, make sure you always have a set amount of emergency fund which is set aside. Like an emergency fund would be something that would be needed to cover at least 6 months of your living expenses. So before you get into equity markets, make sure you have some savings with you that can cover up for 6 months of your living expenses. Then we definitely need a plan that can be adhered to. Just jumping in and out of the markets at the wrong time can lead to massive errors. Like I said, if you need to withdraw your money next year itself, then equity markets may not be the right place. Then you need to look for something like treasury bills. Currently, they are also giving a massive, like 5% interest in the US. So, and they are the safest instruments on earth. So, that is where probably you can park your funds. So, that needs to be managed well. We need to avoid extremely risky bets, be it like the penny stocks, where they just come in and phase in and phase out. So that is something that you need to be aware of. Um, we can rather opt for indices, like I said, the S&P, or you have the Nasdaq, or the exchange traded fund, rather than individually selecting stocks and then rebalancing their portfolios. So we can look for an ETF or an exchange fund. Then we can look when you're investing. Always look for quality names. Okay, for companies which have strong balance sheets. When I say strong balance sheets, maybe they have good cash balances, or the when companies which are showing strong growth in terms of revenues, in terms of profitability. So look for quality names. Then it's obviously always advantageous to when there's a dip, you probably buy the dip and put in some extra. But it's important that we do not overdo and overstretch ourselves. This if you are continuing with a regular SIP and there's a dip in the market and you feel that markets have really fallen, then probably investing a little more at that particular point in time could end up being a favorable strategy in the long run. Then there's also something called as dollar cost averaging. This is something I will cover going forward. And most importantly, if we have retirees or older investors who are into planning to invest, then it's very important that they have enough cash or liquid assets which will be kept aside, which to cover them for the next 2 to 3 years. So that is something that has to be taken care of. And like I already discussed, all eggs should not be in one basket. Some amount of diversification is needed. So when you're investing in the S&P 500, that in itself is obviously providing you with a decent amount of diversification because you are investing in 500 stocks at one go. But when you're investing in S&P 500, you're investing only in the US markets. So that is something that also needs to be taken care of. But at the same time, if you're investing in bonds, so it just needs to be well diversified and well managed. This is again the same slide. When I said keep it simple or what needs to be done, one strategy that can be followed is the SIP in the XPX 500. Or if you want slightly more riskier approach, then you can look at the NASDAQ 100, which is a tech-based index, but the S&P 500 also has a multiple technology stocks covered. Then that is one approach. The other approach that you all can look at is called something called as the ladder approach. Now, this is one of the portfolios that we had shared this year itself at the start of the year. What this strategy focuses on is that you invest in phases. So, say for example, you have 100,000 to invest right now, but markets are at peak. What do we do? So then, in that case, maybe the rally is going to continue, or maybe the markets crash. Then, how do we decide what needs to be done? In that particular case, investing in phases is always recommended. Wherein you invest, say, probably 25% in the phase one. If markets correct further, then you invest the remaining 35%. And if markets correct further, then you invest the remaining 40%. So that's called as a ladder approach, wherein we are investing in phases. So if you look at this particular table over here, we had invested in Nvidia when the prices were 488. Okay, this was at the start of the year itself. And okay, someone's asking, is it safe to invest in low credit rating bonds? Well, no. When you invest in low credit rating bonds, those are bonds with the fact that the credit rating is lower. That means the credibility that the that when you're investing in a particular bond, the credibility that the investor will, that the issuer will pay back the bond is much lower. So in that case, investing in low credit rating bonds are considered speculative. In fact, they are called as speculative bonds. It's always wise to invest in investment grade bonds. I will be covering that in the slide ahead. Right. So quickly, so over here, if you see, we invested in Nvidia when the price was $488. Okay. Now that was a phase one of investments, and we were expecting that if ever the price is correct, we'll invest more. But today, Nvidia is, I'm sure if you are tracking the markets, today Nvidia is already above $800. So it's close to $900 now. So the money has almost doubled in this particular instance, but we did not get to invest at the other two phases. But the beauty about this is that if the stock markets do rally, then at least you've participated in the rally and you've not missed out on the rally miserably. In the meantime, the remaining funds would be invested, like I said, in treasury bills, which do offer, currently are offering more than 5% in the US. Now, coming to bonds, another part of your strategy could be to invest some of your investment in bonds. We have just 2 or 3 slides remaining, and I'll quickly wrap up in the next 5 minutes, and then we take up all the other questions. So, when we're investing in bonds, this is something called as Euro Buxel. It is a bond which is, I know I don't want to overdo it. It's just for your convenience, just understand It is a bond futures contract, which is tracking the prices of a government bond, a German government bond. Um, I'm not going to make it complicated. It's just try and understand how bonds work. Whenever interest rates rally, bond prices fall, and when interest rates fall, bond prices go up. So currently, everywhere, as you are all aware, interest rates are very high, and we are expecting interest rates to fall in the year ahead, or maybe in the next year as well. So when we are expecting such kind of a scenario, it always makes sense, and it could end up being a favorable strategy to invest in bonds. Like you can see, this is the chart of a Euro Buxel. Now, these prices have fallen miserably. They were at a point in time, they were as high as 220 or 230. Now, because of the interest rates high that was there in the Germany, these prices have fallen crazy. These prices track the German 30-year yield. So now we are expecting the ECB rates to start falling, and the German rates also to fall, because of which the Buxel prices are expected to move higher. And looking at the prices, like it's almost at a 10-year low. The prices are near 130, and if the high has been 230, it just makes a favorable risk reward ratio in terms of investments. So another area that can be considered for investment in the current market scenario would be bonds. There are other investment grade bonds. You have US Treasury Ultra. You have investment grade bonds. We have Treasury bills. These are some things that can be covered, and this is how your portfolio can look like. For example, we invest in the blue chip ladder stocks, or in the index ladder, wherein we have the S&P and the Eurozone indices. For example, the Germany, you have France 40. So you invest in a mix of different indices and different blue chip stocks. And we do those investments in a ladder approach, like I just showed on the previous slides. So we have some investments going there. Your remaining investments can be in investment grade bonds. Investment grade bonds are the bonds which have a high category rating, which means that the probability of default of such a bond is much lower. So the chances that you'll be paid are relatively high. So we look for investment grade bonds. Those are quality bonds. And we have other bonds such as the Buxel or the Ultra, and a major chunk can go there. And lastly, we have something called as market neutral strategies or seasonality trades, wherein we can look for investments in these trades as well. So, what are these special situation trades or market neutral strategies? These are something wherein we it would be too heavy to cover in this particular session, but we have many such ideas which are available. Uh, Firstly, I'll just go for seasonality trades so that you can just understand. Seasonality is something wherein a particular commodity moves in a particular fashion in a particular season or in a particular month, which is why we call them as seasonality trades. So, just for a reference and for an example, I have shared over here something called as gasoline seasonality. Now, it has been observed in the past that every time in the month of March, more so in the month of March and to some extent in the month of April, gasoline prices end up going higher. Now, only exception, if you can see, in the last 15 years was the year of 2020. This was in the year March 2020 when everything was shut down, and so gasoline prices crashed. But otherwise, on an average, gasoline prices are always moving higher. So those are something called as seasonality trades. They not it's not available at any and every given point in time. It's available as and when for different instruments. So this is something can be considered. And then we also have something called as market neutral strategies, which will obviously need a lengthier session. I think Yogesh does conduct these sessions regularly, so he can probably cover it, in a separate session. Maybe not in these 4 days, but going forward, we will definitely cover it. Or we can even have one-on-one sessions, because I am sorry, I need to wind it up because we have already crossed our time, and I need to start taking up any questions. Or we can go for a vote. If someone wants me to cover, we can, look into this as well. Now, there's someone who's asked me, what do you mean when markets correct? A correction in the market is referred to as when there is a pullback or when there is a massive a fall in the prices. It's generally referred to as a correction. So, for example, if markets have rallied by 20% and if they fall by 10%, then we call it as there's a correction in the market. If markets fall by more than 20%, then it's termed as we are now in a bear market. And if they rally by more than 20%, then we say that we are currently in a bull market. So I am hoping that I have answered this question correctly. There's someone again who's saying that, okay, please share the PPT. PPT will be shared. We would be uploading the presentation on our webinar, so don't worry. Yeah, in case if you have any more questions, I'm happy to answer. In the meantime, I will just quickly cover as to what is this market neutral strategy that I was speaking about. So there is something called as pair trading, wherein what we do is that we look at two instruments and which are correlated. For example, there's something called as Brent and there's something called as WTI. These are two different versions of oil. So they generally move in tandem with each other. Now, when we look at these two instruments, what we see is that generally, on an average, for example, if Brent is trading at $90, WTI would trade at $88 or $85, things like that. So, on an average, the spread between these two is a difference of $3 to $4. Now, when there's a huge deviation in this spread, so for example, if you can look in the chart, this is the spread chart over here. Now, over here, if you can see, the deviation was of $11. What this means is that this is what I'm referring to, the $11 deviation. That means Brent was trading at a premium of $11. So what happens is that, so that means Brent is trading at 90, and on the other hand, WTI is trading only at 80, less than 79, for example. So in that case, what would happen eventually, we will expect WTI prices to start moving higher because the demand for WTI will start moving up and the demand for Brent will start going down because obviously the price is so high and this gap will start reducing. And so we look at this as an opportunity and we enter and take the trade. Likewise, when the spread between these two really drops, that means Brent starts trading at say $80 and WTI is only at $79. So the difference is just $1. Then we would probably see again Brent prices moving up much faster than WTI, and that again gives us a trading opportunity. So yes, we do look at some opportunities like this as well in the market as and when they arise. So those are some things that can also be considered, but these are very short-term trading opportunities, which would be say available maybe for a month or two or even just for a week or so. That depends on the market dynamics and the market scenarios at that particular point in time. Okay, someone's asking, I came in late in what is SIP and SPX? Okay, once again, SIP is basically a systematic investment plan wherein we are making regular investments in any particular instrument. It can be an equity, it can be a bond, it can be anything where we are investing regularly in the market. So you decide an amount. So for example, I'm investing $1,000, I say every month, or it can be every quarter, or it can be every year. You decide on that amount. Generally, it is considered as every month and a fixed amount. So $1,000 every month. What is SPX? SPX is an index in the United States, which is tracking the largest 500 companies in the US. So it is, if you want to invest in Apple and if you want to invest in Facebook and Microsoft and Amazon and many more such stocks, but you don't buy each stock, it is very time consuming. So you rather invest in the S&P 500 because that will give you exposure to all the 500 stocks which are a part of that particular index. I'm hoping I answered that question. All right. Okay, so that's it from my end today. I hope the presentation was clear and we've tackled most of your doubts regarding the charges. The the RMs will get in touch with you, or you all can also reach out to them. They will help you with all the queries. And in case if you have you need detailed idea about the session, about the understanding of the markets, then you all can always reach out to us, and we are always available to help. It can be a one-on-one session that can be taken. No worries about that. All right, so I hope you had a great session. If we don't receive any question in the next 1 minute or so, I would be wrapping up. And yeah, someone's all right, thank you so much, guys. It was lovely meeting you. Tomorrow we would have a technical session wherein you would be learning about the different entry and exit points in the markets. So that would be very different from what we discussed today. That was today what we did was purely investment perspective. Tomorrow it would be more about trading strategies. So in the meantime, please start using your demo accounts and get a hang of how the platform works so that you are well prepared for tomorrow's session with Vivian. All right, thank you so much. It was a lovely session with you all. Hopefully, seeing all of you all tomorrow as well.